All right, welcome to the July Economic Update for Beyond Wealth Advisors. I'm John Cleaver, partner and senior financial advisor.
And I'm Dennis Bacon, the Chief Investment Officer at Beyond Wealth Advisors.
Well, we're excited to be back. I think it's summer.
It's summer.
It's July.
Hot.
It's very hot. Yes, very hot. And just a few things going on in the economy and the markets these days. So we're going to jump right into it. So there seems to be a number of diverging and countervailing forces that are impacting what's going on in the world right now. Part of that divergence is when we hear people talk about what's going on in the economy and the market right now, there's a lot of different opinions as to how long this economic downturn might last, how deep it may go, and what the opportunity for recovery might look like and how broad that might actually be.
Yeah.
So there's some forces, some countervailing forces that are impacting that, and that's what we're going to focus on today. And we're going to dive right into what some of those forces are that are impacting what we're seeing in the market right now.
Okay. Well, and John, it really is a kind of a unique time.
Yeah.
We're a lot of talk about whether we're going to have stagflation, whether we're going to come out of this. Are we in a recession now?
Right.
Those type of things. I think on the bigger scope, I think we're going to see a little bit of a technical recession, which is basically 2 quarters with no growth.
Right.
But we're kind of in a changing system right now. For the last 18 months, a lot of consumers have been buying a lot of stuff. We're making a shift over to a lot more of a service economy, which is what we were more predominantly prior to COVID.
Pre-COVID, yeah.
So I guess we're kind of in a normalization phase right now, which causes things to kind of bounce up and down a little bit. There is inflation surging throughout the world, although ours is probably a little higher than a lot. Right now, all the central banks, all our Federal Reserve, all the comparable entities around the world are very hawkish. They're all about slowing inflation down. So it's a worldwide thing. Currently, we still have the war between Ukraine and Russia. That's probably going to continue for a while. There's probably not a real end to that in the near future that we really see. We're still seeing the supply chain struggles. One of the big things in the supply chain struggles, which we haven't talked about, is China really has a zero tolerance policy relative to all COVID variances.
Right.
And what that means is all of those places in China that are producing goods that are used throughout the world, when they shut down a province, it's shut down. And there's not really a lot of goods coming out there, if anything. And, so it's kind of an interesting little thing that's going on that is an anomaly and can be done in a communist-ran country because they kind of control everything. Right. So one thing is there. So I think that's that. On the positive side, though, are we going to say something?
No. Well, let me throw in one thing. It feels like the COVID pendulum swung really far one way, and now the market economy is trying to figure out how to come out of it. They thought it was going to come out kind of with one set of outcomes, and it's kind of changed.
Right. And I think a lot of that had to do with the supply chain thing. Yeah. Because people were trying to get stuff. And like I said, I have one part that took 9 months to come in for my leaf blower. Yeah. It's a really nice leaf blower, so I wanted to get the part. But we're seeing that. But what we're seeing on the positive side of the economy right now is we're still seeing unemployment in the 3.6 range. Matter of fact, here in Kansas City, it's around 2.8. Right. I mean that's effectively full employment. And so if somebody wants to find a job, they can find one. And if you're looking for somebody, good luck. Right. So it's really kind of difficult. But we're seeing we've had a decline in the real estate market here in the land because of interest rate climbs and everything. But there's a lot of anecdotal information out there that I hear from. We have a lot of friends who are realtors, etc. And what we're seeing is a consistent buying pattern. It's not a frenzied buying pattern, but it's a consistent buying pattern. And there's been a pickup After everybody went on their vacations in June and July, now it's too hot to go on vacation, so they're going out looking for a new house.
Right.
I've talked to some realtors who actually had really good weeks the last couple of weeks, and people are understanding that, hey, the 2.5% interest rates on new home mortgages is just not going to come back.
Right.
And where we're at in the 5% plus range right now is really more normal on a long-term historical basis. And they're coming to the realization they're just not going to buy as much house as they did before. So we're seeing a lot of activity in that $300,000 to $500,000 type homes, and so that's kind of a really good thing. And because all the millennials, that generation is a huge bump. Right. And the much like the baby boomers, actually bigger than the baby boomers, and that bump is now starting to buy homes. Right. They're a little lagged from where baby boomers were, but that's because of a lot of environmental things that are going on. But now they're starting to buy homes at a much faster pace. Right. So that's one thing. I think also on a little bit more technical side, the monetary policy of tightening that we're doing right now is really going to start slowing inflation down. And that's the countervailing forces there, or you have all of this pent-up demand, and you also have some realization of reality. The housing situation is not going to dry up. Is kind of our opinion. It may slow down a little bit, but it's not going to dry up because there's just too many people that need homes, and we have underbuilt for the last 10 years. Since actually 15 years, since 07, 08, we have underbuilt homes. And underbuilt residences. So we still see that side being really strong. May not be huge growth, but it's not going to weaken.
Absolutely. Okay, so let's talk a little bit about what's the outcome of this cycle. You mentioned it at the open that we hear the word recession. Is a recession coming? Are we in a recession? Are we going to be in a recession? Or when do we start recovery? So how's the outcome of this cycle going to play out?
Well,
that's
let me go get my little crystal ball here and look at it. But if I were going to say, I'd say we're kind of going to have a little bit of a mini recession. This is not necessarily what all the economists are saying. Sure. But I think that divergence from products being purchased to services, that's going to maybe cause a technical recession, even maybe this quarter. And but it's not really going to be felt by most people. Right. And that's mainly because of the employment situation. I do believe that sometime next year we're probably going to have a recession. And this putting the brakes on the inflation is going to really eventually take its toll. And I think it should cause recession. It's not going to be like the Great Recession of 07 through 09. And I don't think it's going to be probably a little bit more like we may have felt in 2000 to 2002, where the market just kind of went flat, sort of up. Technically the market lost money for all 3 of those years, but I have a lot of investments that made money all 3 of those years. So I think a lot of it's just going to be really staying real focused on where you are. I think ultimately we will have a period of tightening and lackluster. I think leading into it, I think we're going to have lackluster growth.
Right. Okay, so that's a great transition. We've been talking mainly about the economy and the forces that push and pull on the economy. Let's transition to the market. We counter those a lot. So where's the market go from here?
Well, right now I consider the market having three basic tenants. Typically you have fixed income or bonds. We have commodities, have kind of been a little bit more in play lately, and then we have equities, which the stock market. The bond market, I think, has the worst. It's behind us. The first 6 months of this year was the worst 6 months for the bond market in 40 years. I think most of that is behind us. We might see a little bit of deterioration, but we also see a lot of opportunities. High yield munis look real good right now. There's a few other things that kind of look good if it fits what you need. I think the concept of actually going out and buying individual bonds really work right now for those people who are bond buyers, who that fits their profile. I think going out and buying those now through the end of the year would be a great time to do that. And then if we have a recessionary period, usually bonds go up in value during that period of time, so it would be a good thing. So I think that's kind of where bonds are. Commodities are in a really funky little thing. Commodities are comprised of 3 components, basically. You have precious metals, you have industrial metals, you have energy, and then you have agriculture. I mean, metals are kind of 2. Precious metals are actually a very small component of that. So looking at gold is not a big deal, but the industrial metals that we use for manufacturing, those in a recession can be hurt. On the other hand, energy is always volatile. It can go either way depending on where supply is. We're having some issues with supply. That's why it's up now. Agriculture, on the other hand, we look, even during a recessionary period, still tends to be really good. And right now, because of a lot of the supply chain issues and stuff, ag prices are up. I expect those to stay up. So I think we've seen bulk of return we're getting in commodities. I think there's some downside risk if we go into a recession. So, but they still may be less risky than equities. But they also don't offer as much opportunity as equities. So I'd say we've kind of tilted back, commodity holdings a little bit recently. Equities, on the other hand, I think we've seen a little bit of a upturn here in the first couple of weeks of July. We're a little late on doing our report this time, but we've seen an uptick in the market. I think that is just part of the volatility factor we're seeing. I really kind of would not be surprised to see another down leg of maybe 10%. I have a lot of people I follow are thinking the S&P, which stands at 38, 39 right now, and that may go down to 34, 35, 33 in those areas. So a 10% drop, basically. I would not be surprised. I also expect by the end of the year to be higher than where we are today by maybe 10, maybe 8 to 10%. So, but it's going to be volatile. I think have a little bit of cash on the sideline right now, just to look for those things. If there's a negative surprise, it could be bad. I see more impetus for a negative surprise than a positive upturn. In the short term, I think once we get out past September or August, September typically are pretty tough times for the market. So once we get past that point in time, I think we'll should see a relatively good return on the market side. And usually the markets bottom out prior to a recession, not during a recession, which is kind of interesting because recessions tend to be relatively short. We think this one will be short and shallow. So I don't think it's going to be real deep. Basically the employment issue. So I really have a fairly positive outlook, probably more so now than I did even a month or two ago. We've seen kind of in June, we kind of wrung out part of the market, and I feel much better about things. So I really look forward to everything except going outside because it's going to be 103 a day or two. I'm glad I don't live in Tulsa, Oklahoma or Dallas, Texas, or I think it's 108 2 or 3 days, 110 in Dallas. So I have a lot of friends in those areas. So those of you who are listening from there, I'm sorry that you're dealing with that.
Well, that's fantastic. And a little longer this month, a little more detail, got into some really good stuff. Be sure to reach out to your advisor and or to our office if you have questions or if you'd like to explore really any of those comments in more detail. And it really is a time of opportunity. I think so. Oftentimes when there's market disruption, it's really the best time to be thinking about what's your next step and how do you take advantage of that. So we look forward to connecting with you soon. And with that, we'll sign off.
Okay. Y'all have a great rest of the summer.